I'm Charlotte McLeod with investingnews.com, and here today with me is Don Hansen. He's a private investor who has been investing in gold and silver mining stocks for over 20 years. Thank you so much for being here. Great to have you again.
Oh, thank you, Charlotte. I'm delighted to be here. This is going to be fun.
I think it is going to be fun, and I think many people in our audience will be familiar with you. We've done a number of interviews over this past year going over your gold and silver stock analysis process, how to build a portfolio, and recently you've been going into other areas of research. So today we're going to be looking at gold and U.S. money supply. This is really hot off the presses. And what we're going to be doing is going through a number of charts that you've sent me. So I'm going to go ahead and bring up the first chart here so we can take a look. And I'll let you get to it, and you can just prompt me when it's time to move to the next chart. So bear with me for a moment as I bring up that first chart here.
Right. So what we see here is the money supply. It's M2 U.S. money supply from 1970 to, I've got 2030 on the chart there. But it shows basically a perfect, smooth, exponential curve, which, and this, you can see it, I've got a data point every 10 years, but it's not real close, except there's a few, here we go. It's every 5 years after 2000. I didn't plot the ones in between the 70s and the 80s earlier, but it's right smooth along that. So you get an idea. The thing that I was struck by in this, not only is it a perfectly exponential curve, meaning that it's getting steeper and steeper over time. It's like acceleration versus velocity. And velocity, which is a straight line, and acceleration is a curving line because it shows that there's an increase in the velocity. And the mathematicians call that the second derivative. Anyhow, that's the exponential curve. And as you can see, it just keeps growing. And I found that extraordinary because the data points laid right on the curve. And you would think with most human activities there would be some variation, but there isn't very much, which it almost looks like there's some sort of natural phenomenon going on here that is being described by this curve, and the data just follows it over this 50-year, well, it would be, if it got to 2030, it'd be a 60-year period, which is, I find extraordinary. I can't understand what's going on with that would be true. There's one other little oddball thing about it. You can see up at the top there that the last data point is 2022, because that's what I had. But something else has happened that has not happened in well over 50 or 60, maybe 70 years. I don't know how many. And that is that from the early 2022 until the present time, the U.S. money supply, M2, actually went down a little bit, maybe 4%, which I have no idea why that has happened, and it hasn't happened in forever. I think maybe the 1930s was the last time that might have occurred. I don't have data that far back, so I couldn't tell you. But that's weird. And when we go to the next chart, I'll explain why I think that's so strange. Here I've plotted the U.S. debt level with the money supply. And if you look at it, you can see how they follow each other. Only the debt is following the money supply growth, but this is data every 5 years through that era, and you can see how they track. So, for the fact that there's a little bit of a blip that has never shown up before, that doesn't make sense when you see how the data is climbing, the debt. I mean, and the debt is climbing ever faster. In fact, where we are now, the most recent number I have is a 2024 number up there. The money supply one is 2022, so there isn't the one right above it. But that was 34 trillion, and we're seeing this debt level growing at about 3 trillion a year. Every 100 days, the U.S. debt now is going up $1 trillion, which is absolutely amazing. So that would tend, and so that's going to go up. So the money supply up should be going up as well, just as it is for the last 50 years, but it's not quite right now. And that's a very big puzzle. And because one of the things, of course, that this shows is that this debt is being covered by printing money. That's pretty obvious, and it's been going that way for a very long time. So then the question is, well, if we're creating more and more debt, then who's buying it? And when you look at that, somebody is buying it. Central banks aren't buying it, and the Fed is supposedly not buying it. But I think what's happening is that the Fed is playing games, and they actually have created a situation where the U.S. banking system, the U.S. banks, are being basically strong-armed to buy it. Because otherwise, there's the only ones left. And this because it's so much money. But I don't have that answer. I don't know that for a fact. But I find that quite extraordinary and ended up coming up with more questions than answers. But certainly the trend is very obvious and is going on for all this time. And the debt and the money supply going up right together over time. And so it tells me that, like it or not, the debt is being funded by something. And it may be that in another year or two, all of a sudden the money supply will explode back up again, or maybe they'll change the way they calculate it and all that. But it indicates to me that there's some kind of desperation going on here, that the government realizes that the debt is growing so fast, and they need to find somebody to put the money up for it. And they're having a hard time doing that. So they've gone to some kind of extraordinary measures, it appears. But so let's stay tuned on that. I think that's an issue that we really need to explore. But again, it indicates that there's a big problem lurking here, in that this debt is growing so fast, and it's got to get funded, and the money's going to get printed somewhere, somehow. And so it's a bit of a mystery right at the moment on that one. But the very least we can say is that this is the trend is clear. Well, let's go to the next slide. This one is probably the most important one I'll show you today, and that is that we have, again, the same money supply curve, but I plotted the gold price alongside of it, and I didn't draw any straight lines through it because there isn't really any straight line as far as the gold price or any irregular curve, except that the gold price obviously is following the money supply up. That we can see. And the other thing that I find really extraordinary about this particular chart is from 2015, if you can see where the circle in the square is above, that's 2015. From 2015 on, the gold price followed the money supply right in line with it, which was not the case at all in the previous the periods. The other thing that's curious about that, you'll see in 1980, where the gold price was way above the money supply. That's the peak in the bull market in gold from the 70s, and I'll show you that in a little while. The other one that's a big anomaly is in 2010, and that again is the second bull market in gold. And actually, that is the two data points I have there, 2010 and 15. As you'll see in subsequent curves, there was a big blip up in the gold price so that it deviated even further from the money supply. But what tends to happen is, over time, that the gold price falls back, in both of those instances, to the money supply curve. And that, I think, is very interesting also, in that it indicates that you're going to have a bull market, the price is going to deviate substantially, but you might want to think about selling at some point in there before it comes back down to the money supply curve again. So I think in the long run, this could be very useful for investors to realize what the pattern is here, how it works. So we'll look at that. But again, the other question is, why did the gold price and the money supply follow each other from 2015 to the present? I have no idea why that's happening, other than we know that there was major changes that happened in the 2010 and 2015 period. that's when the central banks began to buy gold again. If you'll remember from my previous interview, because before that time, they were selling every year. And then in that era, they started to buy it, and now they've been buying it at an ever-increasing rate. Does that have something to do with this? I don't know. But it seems like there's some big things happening in that 2010, 2015 period that are very interesting that I'm curious to know more about what all really happened here, because some significant changes showed up that were different from the previous 40-plus years. So that's that one. And we're going to probably refer back to that, but I have subsequent charts that will show you the bull markets in the 70s and in the 2000s and what those deviation points from the money supply curve, what they actually look like. So let's take the next one. Okay, this is the gold bull market from 1970 to 82 in more detail. And what you can see is when we got here in about the middle of 1979, then the price shot up like a rocket and went up and then came back down again by the middle of 81. So you saw about a 2-year period between mid-79 and mid-81 where it did a round trip way up and then way down again. But the typical thing about these gold bull markets is that the last 2 or 3 years tends to represent a lot of the activity and where you find the peak. And so on this previous chart, that's where we saw that gold price that was way up above the money supply. Well, that's why. It's because it did that. So let's look at chart number 5 now. This is the one, the bull market between 2006 and 2012-13, and it looks a little bit different. It started to come up sooner than the earlier one, but again, if you go from about 2010 to 2012, maybe mid-time, that's when, again, most of the increase in the gold price was the last 2.5 years or so. And then it tapers off again, and it falls back to the money supply curve. And so that's, I think, an interesting feature to keep in mind in terms of what we can expect to see in the current bull market. Now, if we go to the next chart, what I did there was to just hypothetically say, okay, let's say that this current bull market in gold started about mid 2017, and what might it look like as it moves forward if it is going on to a smooth curve like that. And that's what it would imply. But I think that probably we haven't hit the last 2-year period yet, so that I would expect 27, 28, that we would probably be way higher than 3,200. But I could say from just what I see here that we would probably see from 2,200 in the middle of this year up to 3,200 the middle of June of 2026. We would go up at least $1,000 an ounce, and I would expect it to be actually quite a bit more than that because of all the money supply growth, the debt growth, all the rest of it. That it's going to have a parabolic rise. It's going to be much larger, but still, I would think most gold investors would be pretty happy with $1,000 an ounce bump in the next 2 years. And that would be, I think, a minimum based on everything we've seen here. So anyway, I would just fooling around with that to see what that might look like. Then the next curve, please. The other thing that I thought would be useful for investors is to actually look at silver, since we haven't talked about that very much in the interviews that you and I have done. And what you see here is the gold, again, is the squares, and then what the silver did alongside of it. And typically what silver tends to do, it will follow gold, but when you get to the peak, as you can see in 1980, it went way up in a big way and then came back down again fairly quickly. So that was a really hard one to manage as far as how do you make money in silver in that period. But if you turn the curve to the next slide, you will see during this period that the silver didn't go quite so extreme. It started to come up, and then it stayed up for a good while in 2011, 12, and then down into towards 13. It was up high, and in relation to the gold price, so it wasn't quite as extreme. But you can see silver follows gold, but it tends to be more volatile. So it go up higher and then down lower towards the end of the bull market. But again, the interesting thing is that these most of the gains in these bull markets is in the last 2 or 3 years, and I think we are at the beginning of that period, which is why I think there's so much potential for gold and silver investors. And I really think they should look at this as a once-in-a-generation opportunity to make a lot of money, because all the fundamentals and everything, when we look at the history, indicates that we are at the cusp of a major upswing in the price of gold and silver based on what we see here. So I'm very excited about this market, and I hope that your audience is benefited from seeing this, to realize that this is not just hype, that they're really some very solid fundamentals that tell us that gold and silver are going to do extremely well. And in relation to silver, I have not mentioned anything much about that, but I do have 4 favorites that I've invested in, and I will be happy to share that. There are 3 producers and 1 explorer. I think the risk level is quite low. There aren't a lot of silver companies to be invested in, but my favorite is a company called Aya Gold and Silver, and I think it's an extraordinary company. It's the only company that I've run across that produces silver, and 100% of their revenue is from silver alone. And the management is outstanding. They've had tremendous success in Africa in the past. A man named Benoit LaSalle is a tremendous management CEO of it. And it's located in Morocco, which is up in the northwest corner of Africa, and a pretty safe place to be. And I feel really comfortable about the location. But they're going to grow their production from 2 million ounces of silver a year to 10, at least 8, between 8 and 10 in the next year or so. So it's a terrific company. Another one that I like is Silvercrest Metals, and that's in Mexico. And that's also a very low-cost producer. Both Aya and Silvercrest, their cost of production is around $10 an ounce, which is, I like that. They're very low, so even if there's struggles, they're not going to have any problems making a profit. So an excellent company, and also fairly well market capped. I think both Aya and Silvercrest are maybe 1.5 billion Canadian market cap, but that doesn't bother me. I think they're excellent companies, very low risk, and the silver price goes to $50. They're going to go up by 4 or 5 times. I mean, multi-mega cap companies in this sector happen all the time. I mean, Agnico Eagle is $30 billion US. So, I mean, that doesn't trouble me too much when I see that the fundamentals are so strong for both of those companies. But then there's another one in Mexico called Endeavor Silver that's been around a long time, and they're a good company, and they aren't 100% silver, but there's about 2/3 silver, 1/3 gold. So that's fine. A lot of other silver producers that call themselves silver producers maybe produce 60% silver, and the other 40% is zinc and lead and copper and a bunch of other stuff. So I'm much happier to see the Endeavor, and they're a much smaller company right now, but they're in the process of putting a new mine in production in Mexico that will bring them up into the same relative quantity of production as Silvercrest and Aya in the 8 million ounces of silver a year. And silver equivalent in their case, of course, which is also gold. But and that's maybe only a $500 million market cap. Not small, but been around a good while and well managed. And I like them too. The other one is an explorer, also in Mexico. Mexico is the largest producer of silver in the world. You probably know that. And it's called Vizsla Silver, Vizsla. And one of the things I like about that is that the amount of silver that they have in the ground already discovered is much larger than either of the previous three companies. But they're only an explorer, and they haven't got it, they're not mining it yet or anything, but the potential for them is considerable. So I wouldn't invest as much money in an explorer as a producer because there's more risks involved. But this is going to be a mine. It's huge, and it's going to be, I think, quite successful. So those are the four that I would recommend if you're interested in getting into the silver market. And I think it's a good time to do that because silver is very undervalued now. The gold-silver ratio is at an extreme. It's about 90. And in recent years, that gold-silver ratio has fluctuated between 50 and 100. And so maybe 40 and 100. It's been in 2010, it was actually in the mid-30s, the gold-silver ratio. So it's at a very high level, so it's very underloved. And so I think it's a really excellent time to get into silver miners and silver bullion because it's so undervalued with respect to gold. So anyhow, that's what I think. And I actually shifted a fair amount of my money last year in the silver sector because I thought, silver is so unloved, nobody likes it, and that's when you want to buy it.
Exactly. Okay. Wow. Thank you so much, Don, for going over all of your latest thoughts. I think, as usual, you did such a good job of taking historical data and showing us what it means for the present and also the future so that investors can hopefully position themselves. So this is really great. Thank you so much.
Oh, I'm delighted. It's always fun to do these with you.
It is always fun, and hope to have you back again. But we'll wrap it up here for now. Once again, I'm Charlotte McLeod with investingnews.com, and this is Don Hansen. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.